Bob.
Good morning, Bill.
We are talking today about some of the regulatory changes that are occurring and have occurred in 2014 as a result of all of the mess we went through in 2007, 8, 9. And it used to be, well, let's go back several years to when you and I were boys. It used to be that they had...
More than several.
Well, I can speak for yourself. I can speak for yourself. Well, so it used to be that a lender had a front-end ratio of 28%. Your house payment could not exceed, the principal, interest, taxes, and insurance, could not exceed 28% of your gross monthly income. And they had a back-end ratio, all of your long-term debt, your car payment, your more than 6-month installment on your TV, could not exceed 36% of your gross monthly income. And that was years ago.
Right.
And then we went through the 80s and 90s and 2000, and all of a sudden we had no qualifying ratio.
Now, in fact, you could have loans that had commitments over 105%.
And you know, we used to have verification of employment. You had to prove where you worked. You had to have verification of assets, verification of income, all that. And that all sort of went out with Alt-A loans.
Exactly, yeah.
And fascinating, we were looking at a study a few days ago. We did this technical offsite, and we had this study. There was this analyst report produced by Credit Suisse. And they were talking about the percentage of Alt-A loans, which was almost A, but not quite. And they were less than fully documented. They were like 20% of the market, and the Alt-A lenders that were out there, they're all gone.
Wonder why.
So we've had a relaxation of the standards. We tell people there are two numbers to make a loan: credit number on the applicant, collateral number on the property. We just didn't realize when we said credit that meant pulse.
Yeah.
And collateral, that meant, it didn't mean less than 100% of the value. It meant, okay, that'd be a house. Exactly.
Yeah.
There's no limit. So we have these new things imposed. This concept called ability to repay. Now that is a novel concept.
Strange philosophy, and when the Dodd-Frank legislation was passed, you heard a lot of criticism from both sides. On one side, it was very restrictive, and it was too much, and it was going to shut down all the banks. And on the other side, we're letting all the big banks get off. There's not going to be enough oversight, all of that. But when you start delving into Dodd-Frank, it's a very complex and comprehensive regulation.
And all of the implementing regulations have not been written.
That's correct.
Part of them have, and they're phased in. We're living with today a new regulation. It is past the 10th, is it?
I think it is.
Okay, I think so too.
Friday was the 10th.
Okay, so we're past the 10th, and so now we have some regulations on a couple of things. One, ability to repay.
All right.
We have to verify a number of things about the applicant. That seems like common sense. It seems like prudent underwriting.
Yeah, I think...
I guess common sense is neither common nor sensical.
Right, and in the defense of a lot of the lenders, what they were, particularly in some of the high-value property areas, many of the wealthier people who were taking out some of these mortgages didn't typically have a salary. Okay, they had various ways that they were making money, and it wasn't necessarily a salary, so they couldn't just give a pay stub to verify the income. It was very complex to show, well, I've got this, I've got this, I've got this. And so they started relaxing that a little bit initially for the high wealth individuals.
And maybe
then it just sort of migrated.
Maybe that's okay if somebody's got other assets and they can pay. However, for most people, their income is their source of their only source of repayment.
That's exactly right. And what they would do is they started with the high wealth individuals, and they just let it sort of seep into everyone. Well, just tell me what you make, and
I'll write it down. I just sign it right here. And so that's called a no doc or low doc loan.
Exactly right.
Now let's back up and talk about that a moment. In a purely capitalistic economy, as long as somebody's willing to buy it, you've got a buyer out there. A seller is just putting together what the buyer wants. And the buyers like that, the investors like that, because they went back to the Depression and they saw housing values going up, 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 up. They had never gone down. And as a result, they said, well, no big deal. If they can't pay, we'll just foreclose and sell the house. The house will be worth more than it was when we made the loan. It'll be good.
Yeah, you know.
And we saw that in California.
Exactly, and the you know, the whole structure of the mortgage industry, it's somebody has got to validate something somewhere, right? And it doesn't have to be done the way it has been historically done.
It just feels right, though. It's a habit, it feels right.
Right, I mean, it's what we've done in the past. I mean, for example, you could not even have appraisals, for example. You could just get rid of them.
Just go out there and put your thumb in your mouth and say, I think it's worth $200,000.
Right, or you could ask the borrower, or the seller.
Exactly.
Say, how much is your house worth? Okay, and if they pick a number.
Or just take the contract price.
Right. And you could then ask them to buy a bond as part of their selling and to guarantee that the house is worth that much money. I mean, that would work.
Absolutely. And that's, in effect, a form of an insurance policy.
Exactly. And so there are various other ways that this could all be done, but because we have a tradition of doing it this particular way, is constantly trying to tweak it and fix it and put in more controls and try to structure it in a particular way.
Well, I think we want the best number for the least amount of money.
Right.
And so we want to reduce friction in that whole process because friction increases the cost to the borrower.
Right.
And so what are some low friction ways to do that? An appraisal is a low friction way to do that.
Yeah, but it could even be less friction.
It could be less friction.
All you have to do is say you require 40% down, and you could use an AVM, and it'd be fine.
You could, absolutely. It's just that that's more friction to the borrower.
Yeah, absolutely. It would certainly cut down on the volume.
Exactly. All right. That friction will take it way down. All right. That's like running on square tires. I mean,
yeah.
In effect. And so the goal is to have the least amount of friction and the best, basically, independent documentation of the pieces and parts of the process. So when you go in and you just pay cash. But when you go in and you want to, well, most people go in and want to borrow money, they want the least amount of friction, the least amount of cost. In fact, what they really like is the bank to pick up all the charges.
Right.
And that is the case in home equity lending in most cases.
Yeah, it is, and that's a big challenge right now. I mean, there was some articles on the internet this morning about whether or not we should re-examine who has to pay some of these things. You know,
right.
Whether is the bank to pay it, the borrower going to pay it, and who should handle these fees? Where should they reside? That's an ongoing argument.
That's a great question. We have this concept of appraiser independence. The borrower cannot engage and pay the appraiser. It's got to be done to the bank.
Right.
If we look at the investor community, we have a similar conflict of interest, and that is the rating agencies tend to be hired and paid by the originator.
Exactly.
And it seems to me like that is a direct conflict of interest.
Well, it'll be interesting to see. As part of the Dodd-Frank, one of the things that they created was this new Office of Credit Rating Agency Oversight.
Right.
Okay. I haven't seen anything about that.
Well, it seems to me that if you're trying to validate independently the accuracy of what the originator is representing, that the investors would be the natural person to pay those friction costs.
I would agree.
But that's not the way it's occurred.
No. Got tradition.
I know. And so we say, well, it's all baked into the rate the investor pays. Well, maybe it is. It would just be a lot more transparent if it was explicitly paid by the investor. Just like the appraisal being explicitly paid by the lender.
As long as it's not an equity loan.
That's right. The lender pays for the appraisal evaluation in an equity loan too. It's just the borrower usually reimburses in a mortgage loan. They get it back from the borrower in a mortgage, and they a lot of times don't. Now, the theory is they bake it into the rate, and so the borrower really pays. But
yeah, a lot of this is the tradition of the way things have been done, and so they're structuring and trying to figure out how to work around that.
So two things we have to mention before we have to go. All right, we've talked about a lot of things, but two things we have to mention. Two things that lenders have to be aware of as of today, or as of the 10th. One, you've got to document ability to repay. That's just document. There's about 8 things they have to document and in another session we'll cover those 8 things. The second thing is that there's this concept of a qualified mortgage.
Right.
And if you have a qualified mortgage, if a lender makes a qualified mortgage, they're relaxed from some of the burdensome requirements of Dodd-Frank.
Well, mainly is holding some of that risk on their books,
That's
which
right.
is very expensive and dangerous.
That's
for them.
absolutely right. And there will be lenders that will specialize in, or sections of a lender that will specialize in originating non-qualified mortgages.
Exactly.
It's just a risk and pricing issue.
Right.
Well, we've had a fantastic time today. I'm Bill Rayburn with Bob Dorsey. Normally we would be with you next Monday, but next Monday is a holiday, Bob.
It is.
And
so where are you going?
Well,
Caribbean?
actually, no, I wish. I'm going to see a prospect because we have a presentation on Tuesday, so I will be flying. The company will be getting their money's worth out of me on Monday.
It's about time.
Exactly, I know it. And so we're headed to see a prospect for a Tuesday morning presentation. And so we'll be with you in 2 weeks. We hope you have a fantastic holiday next Monday. For now, to you, Bob, bon voyage.
Happy holidays.